fans. This is Alex Shepard with ETF Action. Today is August 7th of 2024. We have recently seen markets decline with fear of the carry trade coming back. We've got a drop in interest rates from the market. The 10-year Treasury has dropped nearly 50 basis points over the last month, almost 1% since October of last year when rates were peaking. So what we wanted to see was, in today's video insight, where are the flows going in terms of duration for fixed income ETFs? What does performance look like between these instruments based on duration? Last time we went through a rate hiking cycle and a rate decreasing cycle. So with that, we're going to jump into the ETF action system. So first things first is we want to take a look at what have flows been doing as we've seen rates drop over the last month and since October of last year. And to do that, we're going to go into the databases and the navigator. And a quick way to see this is just using some of our larger categories based on duration. So what I'm going to do is we are looking at all ETFs in this table. I'm just going to set some filters. I'm going to set a classification filter. We only want to look at fixed income today. I'll select fixed income. So I can get rid of that. And now we have a lot of categories for fixed income. I only want to look at the fast money, some of those government treasury focused ETFs, and just separate it out by duration. So I'm going to use our classification system to do that. So what I'll do is I will go down to category. I'm going to deselect everything. And what I'm going to do is I'm going to select, let's widen this out. I'm going to select government intermediate, government long. Let's do government short. And then I just want to get ultra short as well, which is government. All right. So what we are left with are these four categories. I'll sort them by AUM. Ultra short is the largest category with $222 billion. Government long, $132 billion. Government intermediate, $88 billion. And government short, $61 billion. And if we want to just take a look real quick from a flows perspective, we can see over the last month, government long has taken in $4.6 billion. Ultra short still seeing inflows, and you're seeing inflows across the board. Now, if you were to look at performance over the last month, you'll see that long dated treasuries have done much better than intermediate, short, and ultra short. Why is that? We have seen interest rates come down, and they have a reversed impact on the ETFs or the performance of bonds. So as these rates have come down, we have seen longer dated treasuries do better. Now, I can't say that performance has been great for long dated treasuries over the last several years, as we saw interest rates rise post-COVID from 0% to a target rate of 5.25%. So let's take a look at that too. But right now we have seen flows by and large. Let's go out a little bit longer. Ultra short has dominated with 40 billion, government long 31 billion. Year to date, you start to see those numbers close a little bit, but then you start looking at the last month as rates have started to come down, and there's a lot of talk of potential rate cuts in the future. Currently, the futures market has a more than 70% chance that the Fed is going to decrease the target rate by 50 basis points at its next meeting in September. By the end of the year, it's closer to 1% is what the futures market is telling us. Great site to look at that is the cmegroup.com. They have great charting and the CME Fed rate tool. So I recommend going and checking that out if you have some extra time and you want to look more into rates and probabilities. Now look at the last week, especially as we've seen markets crater and we've seen yields drop. Government long has seen a lot of net inflows, 1.8 billion, whereas you've seen the shorter end of the curve see net outflows. So you're starting to see folks maybe rotate into those longer dated treasuries with the expectation that the Fed is finally going to make its move from having its target rate above 5%. If you just want to look at some of the funds in this category, the largest of which I believe is TLT. Yep, the iShares 20+ year bond ETF. It's a $60 billion product. If you just look at that one by itself from a flows perspective, you can see over the last week, it's seen 1.5 billion in, 2 billion over the last month. Now, let's look at the ultra short category. We'll take a look at that. And I believe it's BIL is the larger one. Yes, the Spider Bloomberg 1 to 3 month T-bill ETF is the category killer in this one with $33 billion in AUM. Let's take it flows. Similarly, over the last week, we can see 592 in for this product. So still seeing net inflows, but by and large, we are starting to see that rotation out of shorter dated duration or treasuries into longer dated. Now, from a performance perspective, let's look at the last several periods of rate hiking cycles and decreases. So I'll open up BIL here. This is going to open up into one of my research frames here, and I'm going to compare it to TLT. And what we're going to do is look at our performance chart. So this smooth, nice, slow and steady wins the race curve here is the T-bill. This is the short dated, ultra short treasury bond ETF, and then our T-bill ETF as a BIL. And the orange line that shows a little bit more volatility is going to be our longer duration, our 20+ year treasury bond ETF, TLT. And this is over the last year. So if you invested in both of these products at the same time last year, you would have a slight outperformance by the 1 to 3 month T-bill, which makes sense. That's interest rates have been above 5%. You're just clipping a coupon and continuing to ride that higher. Whereas TLT is going to move with the higher duration with movements in interest rates. Now let's extend this out. This is where things get ugly. So remember, rates were at zero post-COVID, and then we saw the Fed start making its march higher and higher. During that time period, you can see the coupon rate increases for the short-term T-bill. So this starts to actually accelerate higher and higher because the coupon rate went higher. Whereas TLT, because it has an inverse movement to interest rates, as interest rates continue to move higher and higher, TLT did not fare very well. So you can see during this 3-year time period, ending today, it would be, if you held the T-bill, you're up about 10%. If you held TLT, you would be down almost 30%. Now, let's not forget the period when interest rates went to zero in March of 2020. TLT was excellent. Now, if you held a short-term T-bill, you're essentially capturing 0 basis points in interest because rates are at zero. So TLT had a great outperformance during this period, but then you can see once inflation started going through the roof and we need to start raising interest rates, it didn't go so well. Now the last area I want to look at, just in terms of where we are today and where we were several years ago, is the last rate hiking cycle. And that would have been 2017, most of 2017 and most of 2018. So if I just go in here and I'm just going to drag and drop this time period just to kind of look at this broadly, directionally, we're looking at it. I'll go through here and I can see, let's just stop here. We had some pretty decent comparable performance, but we didn't see interest rates go up that much. But as soon as the Fed signaled back then that they were going to start lowering interest rates, which is in 2019, and then ultimately in 2020, we saw rates, or we saw the performance here for TLT skyrocket upwards. So, not surprisingly, with the inverse movement of bonds to interest rates, when interest rates have gone up, you've seen TLT absolutely get hammered over the last several years. But we may be in a point where we're starting to possibly see the plateau or the future of a higher likelihood of the Fed cutting rates, and it could be very beneficial for those longer dated treasuries out there, such as TLT. Keep in mind, this is all dependent on the labor data that's coming in, the macroeconomic risks to the economy, and also inflation data, which we have steadily seen come down. So if we continue to see that inflation come down, if we see the labor market struggling, the Fed is going to be more inclined to make its move in cutting rates. So keep an eye on that. And that was today's video insight. If you have any questions, reach out to team@etfaction.com. Again, my name's Alex Shepard, and today is August 7th of 2024. None of the securities I talked about today, these are not buy or sell recommendations by me. Everybody should do their own due diligence and speak to a financial professional or financial advisor before making any investment decisions. With that, have a great evening. Take care.